Hello, friends. This is the story of most of us. No matter how hardworking and committed we are, if we do not go to work for a single day, we will not have any income that day. Our financial condition does not allow us to rest, and we are stuck in this net our whole life. We are unable to get out of this rat race, even if we want to, because it has become a part of our needs and responsibilities. But with time, the new generation has become more financially aware and sensible than ever before. Along with this growing awareness, they have also started to understand that working hard throughout life and leading a mediocre life till old age cannot be the true way of living life. This is the reason why today's generation most of the focus is on getting early retirement, earning passive income, and achieving financial independence. So people are showing interest in investing in the stock market because they know that this is the path that can lead them to financial independence. But the problem most people face is how to select the right stocks. This is a big challenge because buying the right stocks at a cheap price is the real answer to investing. This is where author David Solomon teaches us an investing method that helps us meet this challenge. This method is based on the principles of value investing, common sense, and basic discipline. The main purpose of this method is to help you make the right investment decisions in a way that you can create a portfolio of stocks which not only gives you good returns, but also your passive income keeps on increasing steadily. Actually, Falcon is the name of a bird which is expert in catching its prey. Similarly, the Falcon Method also works. The author in his teenage he himself had faced a lot of financial struggles which forced him to decide that he did not want to grow up and get caught in this rat race. The author explains that through this method, you can create a sensible portfolio that will not only help you in making money, but also help you in making money in the industry. In this book, the author has shared his own strategies and experiences, which can prove to be extremely useful for any new or experienced investor. The first principle of the Falcon Method is value investing, which is aimed at ensuring not only financial security, but also financial freedom. It is based on choosing stocks which are undervalued, whose market price is less than their real value by choosing such stocks. You can expect good returns in the future. The second principle is common sense, which is the most important quality for any investor. The author explains that to succeed in the stock market, you do not need excessive intelligence or special knowledge, but you need to use your intelligence and judgment. One should know how to use general knowledge correctly. The third and final principle is discipline. It is very important to control emotions in the stock market and follow the rules set by you. The importance of discipline is very high in the Falcon Method, because your success in investing depends on your patience and discipline. The Falcon Method is a simple but effective investment strategy that helps you choose the right stocks, create your passive income, and achieve financial freedom. This book is useful for all those who want to invest want to make your financial future secure and independent. So, if you also want to get out of this rat race and want to live a secure, independent, and happy life, then adopting the Falcon Method can be a great step for you. Author David Solomon, me 33, achieved financial independence and retired at the age of. He was born in Hungary in 1982 when he was only 10 years old. His parents were divorced, and he lived with his mother, a kindergarten teacher. As a young man, David faced various financial realities that forced him to decide he needed to get a job as soon as possible. The decision to achieve financial independence motivated him, and with his ability and passion to learn, he became financially independent at the age of 33. Now, David Solomon is a full-time investor, and his book, The Falcon Method, teaches us that stock market is a field where we can start very small, and through this, we can achieve financial freedom, so that after some time, our money will start working for us, and not we have to work for our money. David's story and his book shows that with the right investment strategies and determination, anyone can achieve financial freedom and live a comfortable life. In 2011, The world's greatest investor Warren Buffett wrote a letter to his shareholders in which he advised investing, told about the three main types of investment. The first type of these is currency-based investment. Bonds bank is involved in this type of investment. Deposits and other types of safe investment schemes are included. Investors consider this type of investment to be the safest. But the reality is that this is not the best option of investment at all. Its main disadvantage is that the interest received on it is higher than the inflation rate. This means that you can lose the principal of your investment instead of growing it. So putting your money in this type of investment can make your money vulnerable to inflation. Other types of investments are irreplaceable. Music. These investments do not give you any profit as long as you hold them. The profit is made only when you sell them. The problem with these types of investments is that they do not contribute to productivity and do not help in increasing your wealth. No. Now let's talk about productive assets. This type of investment is considered the best. The stock market is a prime example of this. Warren Buffett recommends investing in this category because this is the only category that can leave inflation behind and provide good returns. The biggest feature of productive assets is that you can start with very little capital when you buy a share of a company. You buy a small stake in that company. By being a partner of that company for a long time, you get a good return on your capital. When the company makes a profit, being a shareholder of the company, you also get the benefit. Hence, in the stock market, to be successful, it is important that you invest in good stocks and stick to those stocks for a long time. With productive assets, investors can not only avoid inflation, but also get good returns on their capital. This type of investment. It can be extremely effective in increasing your money and strengthening your financial position. What is Falcon Method? The basis of Falcon Method is that before investing in any company, we should analyze that company thoroughly. 5,000 in Indian stock market. There are more than 200 companies listed, and choosing the right company among them can be a challenge. This is the question we get from the Falcon Method. The Falcon Method says that before buying shares of a company, it is important to know how the company works when we look at a company from a financial perspective, we need to understand it like a black box. Here, black box means that we can see the internal details of the company. You cannot know every aspect completely. As an investor, it is not possible for you to know what is really going on inside the company. But one thing is definitely in your hand. What is going on outside the company? Falcon Method. According to it is important that you understand the input pipes and output pipes outside the company. These pipes are connected to that black box, and they give you a glimpse of the business activities of the company. Input pipes are the components that take the output of the company into account. These include raw materials, human resources, and other inputs that are required in the company's production process. It is important to understand how strong and stable the input pipes are, as it affects the quality and productivity of the company's output. Output pipes. These are the components through which a company brings its products or services to the market. They include distribution channels, marketing, sales, and customer service. It's important that you understand how effective a company's output pipes are, because this can directly affect the company's sales and profitability. Under the Falcon Method, once you have selected the right company and its input and put pipes, once you understand this, the next step is to hold the company's shares for a long time. This suggests adopting a long-term investment approach where you let your investment grow over time while trusting the company's performance. This strategy. The advantages of holding shares of a company are that when you hold shares of a company for a long period of time, you can benefit from the company's growth and profits. This means that you can benefit from the long-term growth of the company without being affected by the small ups and downs of the market. You can take advantage of the long-term holding of shares as compared to buying and selling shares frequently. You can reduce trading costs. This can lead to higher profits, as you will incur lower transaction costs and taxes. Long-term investing. This helps you understand the true potential and performance of the company. You can see over time whether the company is meeting its goals and maintain your investment based on this. The Falcon Method is an effective investment strategy that helps you. It is advisable to focus on choosing the right company and holding its shares for a long time. This can give you long-term gains and reduce trading costs. You can understand the real potential of the company, and therefore, if you want to succeed in the stock market, then adopting the Falcon Method can be a great step for you. On one side of the black box, there are input pipes, i.e. income, whereas on the other hand, there are output pipes, i.e. expenses. The first pipe among the input pipes is revenue. This is the income that the company receives from its customers through its products and services. With this income, the company funds its operations and runs its business. Revenue is the principal that the company receives from its customers. This is the most important income of the company, because this money provides the basis for the entire operation and growth of the company. If the revenue is stable and increasing, then the signs of the financial health of the company are good. The second pipe is borrowed money. This is the money that the company has taken as a loan from the bank to expand or run its business. This money provides immediate funding to the company, but along with this, the company also has to pay interest. This pipe shows how much the company is dependent on external sources and how stable its financial position is. Third pipe is a financial year when the company issues its new shares to raise funds and sell them in the market. Then it comes under equity sale. This is an important pipe because through this, the company gets fresh capital, which is used for growth and an all-round investment. But it is very important to note that some companies give dividends to their shareholders from the money collected in this way, which is not fair at all. Increase in revenue is a good sign of the health of the company, but it is important to ensure that the company's board controls the amount of money. Too much loan can affect the financial stability of the company. Equity sales should be used properly. If the company invests this money in business development, it is a positive sign. But if the money is distributed in dividends, then it can be a matter of concern for investors. Output pipes, i.e. expenses. Now let us talk about output pipes. Here we find various types of expenses which reflect the financial position of the company. In output pipes, the first pipe is ongoing expenses, which are the day-to-day expenses of the company, which include salaries, office supplies, marketing, etc. Advertising is included. It is very important to take care of these expenses because they directly affect the ongoing operations of the company. Ongoing expenses are those expenses which are necessary for the day-to-day functioning of the company. These include employee salaries, office supplies, marketing, and advertising. These expenses include expenses that ensure that the company can run its day-to-day operations smoothly. However, these also need to be balanced and controlled so that the profitability of the company is not negatively affected. The second pipe is capital. These are the expenses that are spent on purchasing such items. Capital expenditures are typically invested in assets that have a useful life of more than 1 year, such as computers, machinery, and buildings. These expenditures are critical to the long-term growth and stability of a company. Capital expenditures done correctly can increase a company's production efficiency and competitiveness. Third pipe. These are the expenses incurred when a company acquires other companies to grow. Such expenses are part of the company's growth strategy and can increase the company's market influence. However, it is important to take necessary precautions before acquiring a company. Complete analysis and planning should be done so that it goes in the right direction. Fourth pipe is payment of debt. This is the money a company has to pay to repay its loans along with interest. This pipe tells us how much a company pays to repay its debt. Proper management of debt is essential for a company's financial stability and long-term success. The fifth pipe is taxes. This is the expense that the company has to pay to the government in the form of tax. Paying taxes properly and managing taxes is an important part of the company's financial strategy. This helps the company avoid legal problems. And this is a sign of good financial management. The sixth pipe is FIF. This pipe tells us how the company uses its profit. Here, we get 3 subpipes under profits. Dividend is when the company spends some of its profit. A share buyback is when a company buys back its own shares using part of its surplus cash. Dividends provide investors with an attractive return and can be a good indication of a company's financial health. Share buyback is when a company buys back its own shares using part of its surplus cash. If the company buys from the open market, it is called share buyback. This reduces the number of shares of the company, and the profit per share EPS can increase. It shows the financial stability of the company and its dedication towards its shareholders. Retained earnings. When the company keeps its profit with itself to grow its business, it is called retained earnings. It is the profit of the company. It is important for long-term growth and development. With this, the company can fund its new projects and expansion plans. It is very important to manage the ongoing expenses and capital expenditure properly. Excessive expenditure can affect the profitability of the company, while the right investment can help in reducing the cost of the company. It can enhance the long-term stability of the company. Balanced management of acquisitions and payment of debts is also important. Right acquisition can lead to growth of the company, while right debt management can reduce financial pressure. Proper use of profits reflects the financial health of the company. If the company manages its profits well, such as dividends, shares bought back, retained earnings, then it can be a positive sign for investors. Thus, the analysis and management of output pipes is very important for the financial condition of the company and its long-term success. As an investor, it is important that you understand all these. Take your investment decisions, keeping in mind the pipes so that you can make a correct and profitable investment. The goal of Falcon Method. Falcon Method advises us to adopt the policy of hold in the stock market. This is completely different from the old quant model. According to this, you buy the best shares through some quantity method. Hold them for a year and then sell them. After this, after doing new research, buy the best shares again and sell them after a year. Repeat this process every year. This process of the quant model is not at all comfortable for an investor. You can also buy shares of companies that you have never heard of. Its big disadvantage is that sometimes it takes time to see the results of the company's plans. It may take more than a year. If you sell those shares in a year, then you lose the opportunity to become a part of the growth of that company. On the contrary, the Falcon Method tells us that we should select good shares quality-wise. We should do this and hold them for a long time. This will help us in holding that stock for a long time. You can earn money in the form of continuous dividends. Only through holdout can investors generate good returns. The main objective of holdout strategy is to buy high-quality shares and hold them for a long time. This approach helps you in growth of companies and gives you a chance to be a part of their success. When you hold a good stock for a long time, you can benefit from the growth of the company and get a steady income in the form of dividends. Thus, the Falcon Method of buy-hold. The strategy advises investors to learn to invest only in quality stocks and hold them for a long time so that they can get good returns over time. This method is ideal for stable and profitable investments over the long term that will help you make the most of the market, protects you from immediate fluctuations, and leads you towards a solid financial future. Adopting a buy and order strategy under the Falcon Method gives you stable returns, long-term growth of the company, and stable returns from dividends. You can take advantage of the reduced frequency of the Falcon Method. This strategy leads you to a well-thought-out and stable investment that will help you grow. Your investments can grow over time and provide you with good returns in the long run. Now, we have to understand the 5 strategies of the Falcon Method. The first strategy is to select a group of top-quality companies. According to the Falcon Method, the first thing you need to do is to select a group of top-quality companies. Selecting quality companies. You should focus on companies that have consistently paid high dividends to their shareholders over the past 20 years. This means that these companies have maintained stability and high quality over time. Says the author, you should never compromise on the dividend history of a company, because a 20-year dividend history shows that the company has faced one or more recessions, and if the company did not cut dividends even during recessions, then it is a sign of a bad company. This is a strong indication that the company has maintained its earning power and strength even in adverse circumstances. When the company did not reduce its dividend even during recession, it means that the fundamentals of the company are strong. This means that the company has a strong financial strength. There is a strong financial structure that can protect it from economic recession. The author advises that you should choose companies that have the highest dividend payout ratio. Dividend payout ratio tells how much of its profit a company gives to shareholders in the form of dividends. When this ratio is high, it means that the company is giving away its profits to shareholders, is returning a large portion of its gross domestic product, GDP, to its investors, which is a great sign. Financial analysis. Analyze the financial data of companies so that you can evaluate their stability and profitability. Dividend history. Check the dividend history of the last 20 years to ensure that the company is profitable. Earning power. Evaluate the earning power and strength of the company so that you can choose a stable and strong investment. Payout ratio. Give preference to companies that have a low payout ratio. The Falcon Method's first strategy recommends you select top-quality companies that have been paying stable and high dividends over a long period of time. This ensures that your investment will be profitable. Be in strong and stable company, which is opposite. Such companies are ideal for long-term investments that can help you achieve your financial goals. By adopting this strategy, you can put your investments on a solid and stable foundation that will help you grow your financials. According to the Falcon Method, an important strategy is to buy shares of any company only when it is available at a cheap valuation. You have to carefully check the price history of the company and find out its average low level. The process will help you understand whether the stock price is at its historical low or not. When you analyze the stock price of a company, the first thing you should do is check its price history. This will give you an idea of the company's price movement over the past few years. It will help you understand the fluctuations in the share price. After this, you will have to find an average low level, which shows how low the company's stock has seen historically. Do you understand the right time to buy? When the company's stock is at its average low. If the stock is trading at a low level, it is a sign that it is a great entry point. It is best to buy the stock at this time because you can buy at a lower price. You can make a good investment and expect higher returns in the future. This can help you get a good deal at a cheaper price. Avoid overvalued stocks. On the contrary, when the company's stock is overvalued, that is, its price is more than its actual value. If so, you should avoid buying that stock at that time. Investing in overvalued stocks can lead to losses and limit your chances of getting better returns. Are you thinking that under this strategy of Falcon Method, you should buy the stock? You should buy it when it is available at a low price and is close to its historical minimum level. In this way, you can select good stocks at a cheap price and get better returns in the future. By doing this, you can be in a profitable position in investment. You can stay focused and achieve long-term success. The Falcon Method. Follow through the shortlisted stocks. Once you have shortlisted the top quality stocks and know when to invest, the next step is to filter the stocks that you want to invest in. Are you ready? For this, you have to compare 3 important things. The first thing you have to look at is the dividend yield. This tells us that it shows that the dividend per share declared by the company in a year is what percentage of the current share price of the company. Do you know that its being high can be a good sign? It shows that the company is giving good returns to its shareholders. Is giving returns. After this, the free cash flow yield has to be calculated. It shows the money that is left after all the expenses of the company. To calculate it, divide the total cash flow of the company by its total number of shares, which will give you will get free cash flow per share. Then, by dividing free cash flow per share by the current market price of the company, you will get the free cash flow yield. Do you understand? This makes it clear how well the company manages its cash. Finally, we calculate shareholder yield. This tells us how much money the company shares with its investors, whether it is through dividends or shares and buybacks. A high shareholder yield indicates that the company is giving a good amount of returns to its shareholders. Don't you find this attractive? Filter the top quality stocks selected under this Falcon Method strategy on the basis of dividend yield, free cash flow yield, and shareholder yield. This will help you decide which stocks are best suited for your investment. The process can ensure that your investment is in a strong and profitable company that can provide you with better returns and stability. Are you ready to implement it? The Falcon Method ranks the survivors. Now that you have filtered and selected the top, once you have selected quality stocks, the next step is to rank those stocks on the basis of current valuation. Now let's know how to do it. The first rank starts with those stocks which are available at a better price than the average valuation. Do you understand that when the valuation of a stock is above normal, it shows that it can be an excellent investment? You should keep these stocks as your top priority as they provide great opportunities at low prices. The second rank also includes those stocks which have average valuation. These stocks are available on. Do you want to know? These stocks are at average price and need to be watched carefully. These come with a medium risk, and you may need more information and analysis about them. Nove in the third rank. These are the stocks which are trading much above the average valuation and at expansive value. Is it correct? Buying these stocks should be avoided as they are selling at higher prices and may provide low returns. This is an indication. Maybe you should avoid investing in them. Under this strategy of Falcon Method, divide your stocks in 3 ranks. Share Me, Honor Nov. In this way, you can easily separate quality stocks from the rest of the stocks and increase your investment. You can manage it smartly. Are you ready to adopt this strategy? Falcon Method. Take qualitative judgment. Now that you have completed all the analysis, your knowledge must have increased a lot. Are you ready? It will be easy for you to take qualitative judgment based on this analysis. In this final stage, your portfolio will now have only quality stocks. Do you understand that you will survive now? You have to stick to them for the long term. The aim of the Falcon Method is to buy quality stocks and hold them in your portfolio for the long term. Only by doing this can you get the best returns in the stock market. And you can create a passive income. Did you know that this way your money will work even when you are not able to go to work? Qualitative judgment. Make the right qualitative judgment using all your information. Long-term holding quality stocks for the long term. Hold better returns. In this way, you can get better returns and passive income. Are you ready to adopt this strategy? Through this process, you can not only get stable returns, but can also build a strong financial future. Now we will discuss about D. You have got complete information about the Falcon Method. The main principles and strategies described in this book to succeed in the world of investments will not only help you improve your financial situation, but will also make you a consistent and self-reliant investor. As we have seen, this method requires thinking for the long term and investing wisely. And it is advisable to keep yourself updated continuously. By adopting this, you can not only reduce the risk, but also increase the possibilities of your investment. If you liked this summary about the Falcon Method, then please like the video. And definitely subscribe to the channel and don't forget to share it with your friends so that they can also benefit from this valuable information. Thank you.